Assalamualaikum and greeting to our beloved lecturer, Madam Nazatul Atilia and our fellow friend. Today, our group will be presenting about Chapter 1, 2 and 3 of subject Investment Management FIN358. For Chapter 1, I will talk about differences among investment. There are three differences, which is gambling, speculation and investment. Investment means to forgo current consumption with the hope of getting higher return for future consumption at minimal risk, while speculation is about buying or selling an asset in expectation of getting large amount of profit from the price fluctuation. And the last one is gambling, which means to bet on uncertain outcome.
We move on to investment goals. For personnel, it's provide insurance protection, education, and providing home. For finance, it provides safety of principles, protection against inflation, and assurance on income. We move on to risk and return.
Systematic risks are uncontrollable and external risks that impact our security equally. Systematic risk has three main factors, which is purchasing power risk, market risk, and interest rate risk. Firstly is purchasing power or inflation risk. They occur when inflation rises and reduces future purchasing power. For instance, if price of goods increase during a stock holding period, investors lose their purchasing power. So to hedge them, we should construct a portfolio. Secondly is market risk. Market risk refers to potential losses from stock price fluctuation caused by tangible or intangible events. Effective timing and analysis can help mitigate the risk. Finally is interest rate risk. Interest rate risk arise when rate fluctuation impact market value and income. For example, when interest rate rise, it can reduce stock price because low demand from buyers. To hedge them, we can choosing short-term fixed income security or holding investment until maturity.
There are two types of unsystematic risk. First, business risk. This risk arises from a business operating environment driven by external factors and internal factors. For external factor, operating conditions imposed by circumstances like the business cycle. For internal factors, the company's operational efficiency. This business risk has strong management and diversification. Next, the second unsystematic risk is financial risk. This risk related to a firm's financial activities. For example, heavy debt. This risk will optimize financial leverage. Next, I will talk about securities market. Securities market is a mechanism for connecting buyers and sellers of financial assets to facilitate trading. There are four types of market. First of all, money market. It can be defined as buy or sell short-term securities. The example of money market are treasury bills and commercial paper. Second, capital market. Buy or sell long-term securities. For examples, stocks and bonds. Third, primary market. New shares issued by firms and sold to the public. There are four channels in primary market, which are initial public offerings, which is IPO, private placements, rights offerings, and sale of shares to employees. Last but not least, the types of market is secondary market. It can be defined as trading of existing shares. There are two channels of secondary market, which are main market, Bursa Mazhab, and SCE market.
Next, I will explain about role of investment banker. Role of investment banker is a firm that acts as intermediary between the investor and the company. It has three different firms, which is Bursa Malaysia, Security Commission, and Stockbroking Company Service. Bursa Malaysia, previously known as KLSA or Kuala Lumpur Stock Exchange. One of Bursa Malaysia function is to provide marketplace for transaction of securities. Second is Security Commission. It established on March 1, 1993. One of Security Commission function is to advise the Minister of Finance. Last but not least is Stockbroking Company Service. It has three different functions, which is education only, advisory dealing, and discretionary dealing.
Moving to the last part in this presentation, which is in Chapter 3. What is investment instrument? Investment instrument include tangible and intangible instrument that investor buy and sell for generate additional income either for short term and long term. In investment instrument, real estate is divided into two, which is financial. Financial is known as the land is built on the land entities such as warehouse and office. Meanwhile, for non-financial, real estate is a tangible asset and not as liquid like financial asset. For example, land, building, and all coins.
The advantage of real estate is the financing to buy real estate is flexible. Due to this flexibility, allow the buyers to leverage loan to purchase property with minimal upfront capital while spreading payment over the time. It's also safe and returns are secured. Besides, real estate requires large amount of capital and the commitment of the repayment is in a long period. Let's look at the type of real estate. For the first type is residential properties, which is personal living to cover various type of houses, for example, flats, apartment, and condominium. Next is recreational properties. Mostly, it will be used for leisure activities or vacation like lakeside, resort, and parks. And last but not least is industrial properties. Usually, it will appear in industrial manufacturing and warehouse to produce customer products such as factories and warehouse.
Chattel is non-financing asset traded in an informal market by buying and selling through a dealers. Chattel is a values determined by supply and demand. For example, antique things, art objects, coins, Chinese ceramic, and classic cars. There is an advantage and disadvantage of the chattel. The advantage of the chattel is it is a high value and it can be sold during the financial difficulties, and a display of wealth. Most items are protected by insurance. The disadvantage of the chattel is it is involve a large amount of money. It is a low liquidity with a high risk and loss of forgery and traded through an informal market, but not by the government. Type of financial asset. First is common stock. It is preferred to as equity securities because investors have an ownership position in a firm for every share or stock shared by them. Second is bond. Bond is a fixed income securities whereby issuer agree to make income payment that fixed by the contract. Third is preferred stock. Preferred stock is issued by corporation which is hybrid securities because the characteristic of bond and common stock. Lastly is a unit trust. Unit trust is an investment company that invests its shareholder money in a diversified portfolio of securities. It's also managed by the professional fund manager.